It's been said that marriage is an investment which pays dividends if you pay interest. Absorb the profoundness of that for a second. Are you done? Good, because I think the same could be said about your money and your investments. And on today's program, we're going to talk about interest, dividends, and value, and we'll leave the marriage stuff up to you. It's a triple header, audience requested ETF battle between ProShares and Vanguard. Stick around. You're watching ETF Battles. I'm Ron DeLegge, and it's nice to see you again. And if you're new to the program, be sure to subscribe to our channel to ensure that you don't miss any of our timely episodes. Also, if you have a certain ETF battle that you'd like to see, hit the comment section below with your ticker symbols. You can also find us on Twitter at ETF Guide. And if we choose your battle, guess what happens? Yes, you win your choice of an ETF Battles coffee mug or a shirt, so make it good. Is there anybody watching that's retiring or already retired? Why do I ask? Well, because you're invited to a webinar that I'll be hosting all about retirement distribution planning. I'm going to show you how to get your Social Security income completely tax-free. Plus, we're going to talk about Roth IRA contributions and conversions and how that can be used to maximize your after-tax cash flow. Be sure to hit the description section below this video to register. Do not miss it. Today's matchup features a dividend ETF from ProShares, ticker NOBL, going up against a pair of Vanguard ETFs, ticker symbols VIG and VTV. VIG is a dividend growth ETF, while VTV is a large cap equity value fund. This battle was requested by a longtime viewer named Dave Schmarter, who refers to himself as a middle-aged baby boomer. What's wrong with that? Will you still need me? Will you still feed me when I'm 64? Anyway, I like the timing of this ETF battle. I think it's quite good. Value stocks are coming back into vogue, and you couple that with the popularity of dividend investing, and man, it makes for a great showdown. Judging today's high-stakes contest is Tom Psarofagis with Bloomberg and David Dierking with TheStreet.com. Judges, great to see you.
Very happy to be back.
Hi, Ron. You have a beautiful voice.
Oh, well, I appreciate that. I've got to practice. So the ETFs in this contest will go head-to-head across 4 battle categories. Our judges are going to give us their analysis, and I'll be keeping track of the results. At the end of this show, we'll declare an overall winner or end in a split decision if there's no consensus winner. Now, our judges are free to nominate ETF wildcards if they like an ETF opportunity elsewhere. Now, keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or any of the judges. So let's get started with the first category, cost. Tom, kick us off.
Pretty hard to go up against Vanguard and win the cost battle, and this one's really no different. NOBL is 35 basis points. I think that quickly sort of eliminates it. Then in the other two, which are pretty close, you have 6 basis points for VIG and then 4 for VTV. And so I think this one pretty clearly goes to VTV at 4, not only because it's just the actual expense ratio, but spreads wise, it trades a little bit more than VIG. The spreads are a little bit narrow. So overall total cost of ownership, I would give this one to VTV.
Thank you, Tom. That's a strong start. David, how do you see it when it comes to cost?
Yep, I completely agree. I'm not sure I even have much to add to that argument. You could probably, split hairs on VIG and VTV and the 2 basis point difference, but we'll go with just the straight lowest expense ratio here. VTV at 4 basis points is the winner.
Next up is exposure strategy. So, David, you're still up. Break down this ETF battle for us.
Yeah, I think on this one, you could probably lump NOBL and VIG together since they're both targeting long-term dividend growers. VTV is kind of the outlier here. It invests in large caps with value characteristics, and it's looking pretty much at the traditional valuation metrics, so price to earnings, price to book, and things like that. NOBL looks strictly at S&P 500 companies with a 25-year history of raising their dividends. VIG goes a little broader. It only looks for a 10-year dividend growth history, so you got a few more names in there. These three portfolios all have different tilts to them. Noble is a little more defensive, leans towards the staples, and utilities a little more. VIG has a little more growth pop to it because you've got a few more of the tech names that are still emerging dividend growers. VTV obviously has the value tilt. It's got a few more cyclicals in it. It's overweight to energy and financials a little bit. So it kind of depends on which route you want to go down. For me personally, I would go with VIG on this one because of better diversification. If you look at the portfolio, it's got 6 different sectors that have at least 10% allocations to it. That ends up lowering the risk a little bit. Based on diversification, I'll go with VIG on this one.
Thank you very much, David. Tom, you're up next. How do you see it in terms of exposure strategy?
Sure. Yeah, that was a really good rundown, and he brought up a good point that they're a little bit different, and depends who you ask, right? Dividends can really maybe be a subset of value, right? And so, VTV, like I said, is a little bit its price to book. And the other interesting thing about VIG, it recently switched indexes about a year ago or so. So the methodology didn't change all that much. It's still 10 years of growth. I think they sort of just added some buffers in terms of reducing the turnover, which is, I think, a net positive for that fund. And then, Noble just being 25 years of growing. The reason why I like Noble here is for almost the opposite reason of what Dave's saying, that this one's a little bit more concentrated. So it's got the lowest overlap with the S&P, and that's sort of things I like to look at. Because obviously I'm making some assumptions here, but I'm assuming a lot of investors already have exposure with the S&P. VIG and the other Vanguard one, they're a little bit more watered down. They're a little bit broader, so you're going to get quite a bit of overlap with the like a broader benchmark. So in this case, I just like sort of the different exposures that you're not already getting. So it only has a 15% active share with the S&P, and so this one I'm going to give to Noble in terms of its exposure.
Thank you, Tom. I appreciate that outstanding analysis, and that takes us next to performance. So, Tom, you're still up. Give us your analysis.
Yeah, obviously this depends on what period we're looking at, but I've really been noticing the outperformance in Noble, and I think in the context that we need to look at it, there's 2 things. Is one, value is doing well overall, so VTV's outperforming the S&P, and these other ones are outperforming the S&P. But the other thing I think we need to put in context is with rates. And what I look at is how sensitive are these dividend ones to move in rates. And I've actually been finding that Noble tends to still outperform some of the other ones when rates are going up. And just given that we're in a rising rate environment now, I like the way Noble behaves in a rising rate environment compared to the other ones. So performance, I'm also going to give, again, back to back to Noble on this one as well.
David, you're up next in terms of performance. Do you agree with Tom's analysis?
Yeah, I do. I think you brought up some great points as far as where we are in the economic cycle and raising interest rates. And I think that's going to be an important point to really consider if you're looking to make a brand new investment in any one of these 3 funds here. If you look back at the history of these 3 funds, since Noble's the youngest of them, it launched back in 2013. If you look back over that period, the overall performance isn't really that dissimilar. VTV trails a little bit, but not a whole lot. If you look at the yields on these funds, the long-term dividend payers, if there is a drawback, they tend to have low yields on them. Both Noble and VIG are just a little under 2% each. VTV is a little higher at about 2.2%. So even though it doesn't target dividend payers, it's kind of a happy accident that it happens to yield more than the other 2. I'm going to agree with Tom on this one. I like a little more of the defensive nature of Noble here, and I think that's going to be a little better position going forward. Noble gets my vote.
Next up is the mystery battle category. This is one of my favorite categories because it's where our judges can pick that single factor or multiple factors to make their arguments, and they also get to surprise us. So, David, you're up. What is your mystery battle category, and who wins it?
Yeah, I'm going to piggyback on the performance discussion we just had and actually look at risk-adjusted returns, because I think if you take a look at how the funds are taking risk within the portfolios, I think we've got a fairly clear winner here. If you look at the standard deviation of returns on VIG, it's about 8% lower than the other 2 over its history. The beta is modestly lower. The downside capture is a little less, and I think into the environment that we're heading into, I think we need to consider drawdown risk with each of these funds. And VIG actually has done a better job of offering a little more downside protection in this. If you look at the Sharpe ratios on these funds, which is a measure of risk-adjusted returns, the higher number is better. VTV is at 0.72, NOBL is at 0.82, and VIG is all the way up at 0.96. So if we look over history, NOBL and VIG have performed pretty similarly in terms of absolute returns. VIG has done it, though, taking a little less risk, and I think that's going to be important going forward. I give VIG the nod based on risk-adjusted returns.
Thank you, David. Tom, you're up next. What is your mystery battle category and who wins it?
Sure. I mean, it's sort of hidden in there in yield, and Dave sort of alluded to it. I saw the same thing. It's kind of interesting that VTV, though not explicitly a dividend strategy, yields the most. And so, like I said, that's a pretty happy accident. And when you couple that with cost, I think that's really important, because actually NOBL does yield a little bit more than VIG, but it's got a 35 basis point expense ratio. You're giving back a good chunk of that yield. So not only does VTV have a higher yield, it also has the lowest expense ratio. So I sort of like that combination, that you're yielding a little bit more and you're not giving as much of it back. So the mystery one, sort of yield per unit of cost, let's call it, I'll give that one to VTV.
Thank you, Tom. And now we shift to the part of the program where our judges get to give us their overall battle winner. So Tom, give it to us.
Yeah, it's a tough one, but I really do like NOBL here, and I'll go back to the active share. It's very different. I also like that it's equal weighted compared to market cap weighted, so it does have a little bit more pop potential. Could be a little bit more volatile too. So I'd like that it's equal weighted and sort of everything has an equal say in the portfolio, and it's concentrated. So overall, I really like NOBL as a dividend play.
Thank you, Tom. I got you down for NOBL. David, your final opportunity to weigh in with your overall battle winner.
Yeah, I'm going to go with VIG here. I just think, looking at the history of the fund and the composition, I like the more diverse approach of VIG here, although I understand what Tom is saying with regards to NOBL. I think, like I just mentioned, it's got better risk-adjusted returns. It's looking at a potential lower risk profile. I like how it's spread across different sectors, so I'm going to give the win to VIG on this one.
Well, our judges have spoken, and according to my battle scorecard, today's winner is a split decision between NOBL and VIG, and our judges made some awesome points. Tom favoring NOBL. He likes it for its lower overlap with the S&P 500, and you really got to think about that, especially if you're pairing this with a S&P 500 index fund or a composition similar to that, and making sure that you're not over diversifying. He also likes the equal weighting, the active share of NOBL. And then for David's argument, he said, wait a second, I like the risk-adjusted returns for VIG. I think going forward, if we're going to get more volatility and perhaps downside in the equity market, that would be a consideration to give in favor of VIG. And also, it's got a broader dividend strategy versus just S&P 500 high dividend payers or consistent dividend payers that increase their dividends. And so that was a point that he made, and also likes the sector composition and diversification of VIG. So I think both of you raised some awesome points, and you guys are like oil and vinegar. But you know what? Oil and vinegar aren't that bad on a salad. so I like you guys together, as a matter of fact. But this certainly has helped us to really better understand what things we should be looking at in making some of the ETF choices that may be at hand. And again, thank you so much, judges, for your insightful analysis and helping us break it down. Well done.
Thanks so much, Ron.
Thank you, Ron.
Keep up the good work, Tom and David. We'll be catching up with you soon. My question to you is, which ETF battles would you like to see in our next episode? Post your ticker symbols in our YouTube comment section below, or find us on Twitter at ETF Guide. Thanks for watching. I'm Ron DeLegge, and until next time, watch the battle before you invest.